you a rundown on monetary policy, fiscal policy, economic indicators, market indicators, some interesting developments there. I'll start first with fiscal policy this time because I guess overnight the Inflation Reduction Act passed. And according to academic studies, I believe Penn is one, this package probably will not reduce inflation because growth will be slower than otherwise would have been the case, according to their models. Therefore, productivity will probably be lower than otherwise would be the case, and inflation slightly higher, not terribly higher, but not going in the right direction. I guess from an investment point of view, I think there's a terms of trade effect here in that our corporations with more than $1 billion in profits, who were paying less than 15% corporate tax with all of their deductions and such, or perhaps because of their geographic positioning, they will have to pay a minimum of 15% now. So I think that will be to the detriment of more U.S. Corporations than others in the world. So a little bit of a terms of trade effect there. Prescription drug pricing, Medicare negotiations, negotiated prices. That's a slight negative, of course, for the healthcare industry. I guess the IRS is now going to have another $80 billion over the next 10 years to oversee our tax policy and compliance. And Larry Summers thinks that alone could raise almost $1 trillion. Whereas I think in this package, they're assuming it's more like the $200 to $300 billion range over 10 years. Well, if nothing else, that might increase compliance from a tax policy point of view. So now, one thing to note importantly, I've mentioned it a few months in a row now, is that federal outlays are falling. They're down 14%. Now, the government sector is almost 20% of GDP. So that's a big hit to a big slice of the economy. Now, it's understandable because it's really just the runoff after the stimulus payments last year. But the important thing to note is those who were expecting inflation to stay in the system, or who are, much like it did in the 70s. One argument, because back in the 70s, we never saw federal outlays declining. In fact, I think the Vietnam War started social safety net programs. So the combination was called guns and butter. The government was funding everything. And that started in the mid-60s and continued throughout the 70s. We never saw a reduction in outlays. So that's a big difference. So fiscal policy is a big drag on the economy right now. Monetary policy, so we've gone from 27% money growth on a year-over-year basis in mid-2020, down to 5.9% in June. It looks like July will be in the low fives. And if you look at the money numbers sequentially, what you will find is they have flattened out for the last few months. Now, if that were to be sustained, that trend or lack of a trend, then we would be working down to 0% money growth over the next six months or so, and possibly negative. Some people do believe the money growth rate will go negative. And if it does, I believe that will be the first time since the Great Depression in the 30s. And of course, that would also represent a tremendous drag on economic activity. So we've got both sides of policy, fiscal and monetary policy, really moving in a pro-cyclical manner. What that means is typically in a recession, they'd be counter-cyclical. You'd be stimulating. They're doing the opposite this time around. And I think that's why a lot of people are going to be surprised at this idea that we actually are in a recession. Now, the Fed is basing policy on two lagging indicators. They're looking at headline inflation, or it's actually core inflation, but they're looking at inflation indices, broad-based inflation indices like the personal consumption deflator or the CPI or the PPI. And those headline numbers look awful right now and have been pretty sticky in the last few months. And so I think the CPI is up to 9.1% on a year-over-year basis. And I think the PPI is up 11.3%. So those are very high numbers. And as you know, we don't think they're going to be sustained. And in fact, we think that this monetary policy and fiscal policy restraint in the midst of a recession is going to cause much faster decline in pricing than we believe the market is anticipating right now. The other lagging indicator that the Fed is focused on is employment. And one of their arguments that the economy can withstand 75 basis points, which they just put in place another 75 basis point increase up to 250 on the Fed funds rate. And they're focused on employment. Employment is robust, and surely because employment's robust, we cannot be in a very severe recession. But the GDP statistics. So real GDP growth has been negative for 2 consecutive quarters. Now that's what I've always viewed as a technical recession. Usually there's not much pushback to that, but there has been this time around. But one of the confirmations that we're in a recession are the leading indicators. So there's a leading indicator index that the government puts out every month. And whenever it has shown 3 consecutive months of decline, as it has, we have been in a recession. So this is subject to revision. We won't be able to tell for a while. But employment is a lagging indicator. These headline inflation measures are lagging indicators. And in trying to understand if that number was real, what is it? And when you take apart the index, what you find is that there were more women. The disproportionate number of jobs created were for women, and we're beginning to wonder if perhaps these employment numbers are picking up a person who has taken on 2 jobs. And there are various measures of employment. This one, it's possible that is happening, whereas the household employment measure, which is a much broader survey. It's not of corporations, it's of people in their homes. That measure of employment, it moved up. I think it was up 179,000 this month, but much weaker than non-farm payroll. And if you look at the last 4 months, it has dropped by 200,000. So it's quite weak over the last 4 months. And it could be because household, the survey basically says, are you employed? I don't think it asks, are you employed at 2 jobs? So that may be one of the explanations here. The reason we don't believe that employment is that strong is almost every other employment indicator that we have been monitoring is telling us that employment is weakening rapidly. If you look at initial unemployment insurance claims, they bottomed at, I believe, around 170,000, if I'm not mistaken, and we're up about 55% since then. 55%. That is the fastest increase in that measure of unemployment that we have seen in a recovery. In a recession, in a recessionary period since 1969, which is as far back as we went in terms of analyzing this.